Warren Buffett. Why most people will lose money in the next crash. Are you truly prepared for the next market crash? Not just financially, but mentally? It's a question worth asking because history tells us that most people aren't, and the cost of being unprepared is staggering. Did you know that during the 2008 financial crisis, the average investor lost over 40% of their wealth? Even more shocking, a J.P. Morgan study found that while the S&P 500 averaged 9.5% annual returns over a 20-year period, the average investor earned only 2.9% during the same time, largely due to panic selling during downturns. Here's what most financial advisors won't tell you. While millions of Americans were watching their retirement accounts crumble during past market crashes, Warren Buffett was quietly deploying billions of dollars, buying quality companies at bargain prices. In fact, some of Buffett's most profitable investments ever were made during periods of maximum market fear, when most people were rushing to sell. In today's video, I'll reveal the 7 critical reasons Warren Buffett believes most people will lose money in the next market crash. Each one exposes a common mistake that could cost you thousands or even hundreds of thousands in the coming years as economic uncertainty grows. Stay with me until the end, because I'll share Buffett's most powerful wealth protection strategy, one that goes against everything you're hearing from mainstream financial media right now, but can make all the difference in preserving and even growing your wealth when markets tumble. Are you already taking steps to prepare for the next market decline? Type "ready" in the comments if you believe you're prepared, or "concerned" if you feel vulnerable to the next crash. Let's explore why Warren Buffett sleeps soundly through market turmoil and how you can too. Let's start with the first reason Warren Buffett believes most people will lose money in the next market crash, and it's something that affects all of us, regardless of investment experience. Most people invest based on emotion, not logic. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." This insight reveals a fundamental truth about human nature that costs investors billions during every market downturn. Here's the uncomfortable reality. Our brains evolved to keep us alive in a dangerous world, not to make sound investment decisions. When markets plunge, our ancient fight or flight response kicks in. Your brain literally responds to falling stocks the same way it would respond to a physical threat. Studies show that financial losses trigger the same brain regions as physical pain. We're hardwired to flee from danger, to sell when stocks are falling, precisely when we should be considering buying. Look at Buffett's actions during the 2008 financial crisis. While most investors were selling in panic as banks collapsed and the Dow lost over 50% of its value, Buffett was calmly deploying billions. He invested $5 billion in Goldman Sachs and later $3 billion in General Electric when both were on the brink. Those investments later yielded over $10 billion in profit. While emotions told everyone to run, logic told Buffett to buy. The solution isn't trying to eliminate emotions. That's impossible. Instead, create an investment plan before market crashes happen, when you can think clearly. Write down your strategy for different scenarios. If the market drops 20%, I will invest X amount in these specific companies. Then, when emotions run high during a crash, you simply follow your pre-written instructions rather than your feelings. Think of it as leaving instructions for your future, emotionally compromised self. This brings us to the second reason Buffett sees most investors losing money in downturns, a problem that becomes even more dangerous when combined with emotional decision-making. Most investors have no plan for market downturns. Risk comes from not knowing what you're doing. Buffett has warned for decades. Yet surveys show that fewer than 30% of individual investors have any written plan for how they'll respond when markets crash, and they always crash eventually. The harsh truth is that most investment strategies are designed only for rising markets. When someone asks, "How's your portfolio doing?" they're almost always asking how much it's up, not how well it's protected against disaster. This one-sided approach leaves investors completely unprepared for inevitable market declines. Consider how Buffett positions Berkshire Hathaway. While most fund managers stay fully invested to maximize returns in good times, Buffett often maintains a massive cash reserve, sometimes over $100 billion. This isn't because he's afraid. It's because he knows market crashes create rare opportunities. When the 2020 pandemic crash hit, Berkshire was ready with cash while others were forced to sell at terrible prices. The smart solution is creating a balanced portfolio with specific allocations that consider both bull and bear markets. This might mean keeping 20 to 30% in cash or cash equivalents, no matter how tempting it is to be fully invested during booming times. It means having some investments that tend to move in the opposite direction of stocks, providing stability when markets tumble. Most importantly, it means knowing exactly what you'll buy and at what prices when the market drops. Remember, a market crash isn't a time to improvise. It's a time to execute a plan you created carefully in advance. As Buffett says, predicting rain doesn't count. Building arcs does. And speaking of building arcs, the third major reason most people lose money in market crashes directly connects to both emotional investing and poor planning. Lack of patience, selling too soon when markets drop. The stock market is the only store where, when things go on sale, everyone runs out the door. Buffett once quipped. This observation highlights perhaps the most costly mistake investors make in downturns, selling quality investments at panic prices, then missing the recovery. Here's the brutal reality most financial advisors won't tell you. Market crashes are normal and temporary, but the losses from panic selling are often permanent. Since 1980, the S&P 500 has experienced 37 market corrections of 10% or more. Yet the market has still risen approximately 8% annually over that period, turning $10,000 into over $760,000, but only for investors who stayed invested through the turbulence. Take Robert's story from the 2020 pandemic crash. When the market plunged 35% in March, fear overwhelmed him. He sold his entire portfolio, converting paper losses into permanent ones. By the time he felt comfortable reinvesting 6 months later, the market had already recovered most of its losses. That one emotional decision cost him over $120,000, money he'll never recover. The wiser approach is to view market crashes not as disasters, but as rare sales on quality businesses. Would you panic if your favorite car, normally priced at $50,000, was suddenly available for $30,000? Of course not. You consider an opportunity. Great businesses are no different. As Buffett advised, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Have you ever sold investments during a market drop and later regretted it? Type patience in the comments if you'd like to learn specific techniques for developing a more resilient investment mindset during market volatility. Now, let's explore the fourth reason Buffett sees most investors failing during market crashes, one that prevents them from capitalizing on the opportunities that downturns create. Not having enough cash to capitalize on opportunities. Cash is to a business as oxygen is to a human. Never thought about when it's present, the only thing in mind when it's absent, Buffett has observed. This seemingly simple insight explains why most investors miss the incredible buying opportunities that market crashes create. The uncomfortable truth is that without cash reserves, market downturns become threats rather than opportunities. When stocks of exceptional businesses suddenly trade at 40 to 60% discounts, most investors can only watch on the sidelines, their money already fully deployed in now declining investments. Meanwhile, those with cash reserves can acquire these bargains, positioning themselves for extraordinary returns when markets recover. Look at Buffett's actions during market crashes. In 2008, while others were forced to sell at devastating losses, he deployed billions in cash to acquire stakes in struggling giants like Goldman Sachs and Bank of America. These crisis investments later generated over $10 billion in profits. During the 2020 pandemic crash, he purchased nearly $10 billion of natural gas assets at fire sale prices. In each case, it was a substantial cash reserves, often criticized during bull markets as drag on performance, that enabled these opportunity-seeking investments. The solution isn't complicated, but requires discipline that most lack. Maintain a sizable cash position regardless of how tempting it is to be fully invested when markets are rising. Consider allocating 20 to 30% of your portfolio to cash or cash equivalents like treasury bills or high-yield savings accounts. This money won't generate exciting returns during good times, but it transforms into powerful opportunity capital during market crashes. Think of this cash not as money sitting idle, but as potential energy, like a coiled spring waiting to be released at precisely the right moment. When quality stocks drop 30 to 50% in price, you'll have the financial means to act, while others can only wish they could buy at such prices. This brings us to the fifth reason Buffett identifies as a wealth destroyer during market downturns, one that turns manageable market declines into financial catastrophes. Too much leverage debt. You really don't need leverage in this world much. If you're smart, you don't need it. If you're dumb, you shouldn't be using it, Buffett has bluntly stated. Yet the allure of borrowed money continues to trap investors in every market cycle. The harsh reality is that leverage amplifies everything, both gains and losses. When markets are rising, borrowed money makes you feel like a genius. But when markets inevitably decline, that same leverage can wipe out years of gains in weeks or even days. Worse, it often forces selling at the worst possible time when margin calls hit. Consider what happened to thousands of investors in March 2020. As markets plunged over 30%, those using margin loans received the dreaded margin calls, demands from brokers to deposit more money or sell holdings immediately. This forced liquidation turned temporary paper losses into permanent ones, precisely when smart investors were buying, not selling. Warren Buffett built his $100+ billion fortune without significant leverage. Berkshire Hathaway maintains minimal debt relative to its size, with most of its operating companies carrying little to no leverage. This conservative approach means that when others are forced to sell during crises, Buffett remains in control of his decisions. The practical solution is straightforward but requires resisting temptation. Invest only with money you actually own. If you're considering using margin loans or other forms of leverage, ask yourself, can I sleep soundly if my investments temporarily drop 50% in value? With borrowed money, such declines can entirely wipe out your equity while still leaving you in debt, a catastrophic double blow. This connects directly to the sixth reason Buffett sees investors losing money in crashes, a fundamental flaw that becomes especially dangerous when markets turn turbulent. Lack of understanding about what they own. Never invest in a business you cannot understand. Buffett has repeatedly advised. This principle has helped him avoid countless investment disasters, from the dot-com bubble to complex derivatives that later imploded in the 2008 financial crisis. The straightforward truth is that during market panics, you cannot maintain conviction in investments you don't fundamentally understand. When a stock you own solely because it's been going up or everyone is buying it suddenly drops 30%, you have no framework to determine whether this is a buying opportunity or the beginning of a permanent decline. Consider how Buffett navigated the dot-com bubble. While technology stocks soared to absurd valuations in the late 1990s, he largely avoided them because he couldn't reliably predict which companies would be winners 10 years later. Critics call him outdated and out of touch. Yet when the bubble burst, Berkshire preserved capital while tech-heavy portfolios were devastated. His defense was simple. He stuck to businesses he understood. The solution isn't to avoid all complex investments, but to ensure you have a clear understanding of every holding in your portfolio. For each investment, you should be able to explain in a simple paragraph what the company does, how it makes money, why it has advantages over competitors, and what could cause it to fail. If you can't articulate these basics, you own speculation, not investments. Can you clearly explain the business model of every company in your portfolio? Leave a comment saying, knowledge is power. If you want to learn how to simplify your investments and build a portfolio of businesses you truly understand. Finally, the seventh reason Buffett believes most investors will lose money in the next crash might be the most fixable, yet most people never address it. Lacking a clear strategy to capitalize on market declines. Be fearful when others are greedy and greedy when others are fearful, Buffett famously advised. Yet while many investors can quote this wisdom, few translate it into specific, actionable plans that they can execute when markets collapse. The stark reality is that without a concrete action plan, most people freeze during market crashes. The combination of fear, uncertainty, and the overwhelming nature of rapid declines creates decision paralysis. By the time they process what's happening and decided to act, the best opportunities have often already passed. Consider how differently Buffett approaches market declines. Long before crashes occur, he maintains a watch list of excellent businesses he'd like to own at the right price. When the 2008 financial crisis hit, he didn't need to figure out what to do. He already knew exactly which companies he wanted to buy if their prices dropped significantly. This preparation allowed him to move decisively, investing billions in Goldman Sachs and Bank of America, while others were still trying to make sense of what was happening. The practical solution is to create your own opportunity framework before markets decline. Build a crash wish list of 10 to 15 high-quality businesses you'd love to own at lower prices. For each company, set specific price targets that would represent exceptional value. When market panic inevitably strikes, you won't need to rely on in-the-moment judgment. You'll simply check if any companies on your list have hit your predetermined by prices. This methodical approach removes emotion from the equation. Instead of seeing market crashes as frightening events, you'll view them as potential opportunities to acquire parts of great businesses at bargain prices. As Buffett says, the best chance to deploy capital is when things are going down. Now that we've explored the 7 reasons why most investors will lose money in the next crash, let's talk about how you could be among the minority who not only survive, but potentially thrive during market downturns. Now you understand the 7 critical reasons why Warren Buffett believes most investors will lose money in the next market crash. Emotional decision-making, lack of preparation, insufficient patience, inadequate cash reserves, dangerous leverage, poor understanding of investments, and the absence of an opportunity strategy. These aren't just theories. They're battle-tested observations from someone who's weathered every market crash since the 1960s and emerged stronger each time. The good news? Every single one of these vulnerabilities can be addressed before the next downturn hits. This week, take a clear-eyed look at your investment portfolio. Are you investing based on emotion or logic? Do you have adequate cash reserves to not only weather a storm but capitalize on it? Could you explain each of your investments to a 10-year-old? Most importantly, do you have a written plan for exactly what you'll do when markets plunge? Leave a comment saying prepared for crash if you're taking steps to protect your wealth using these principles. I read every comment and would love to know which of these 7 factors resonated most with your situation. In our next video, I'll share Buffett's actual investment watch list, the specific types of companies he looks to buy when markets crash, and how you can build your own opportunity list before the next downturn arrives. Remember, the greatest transfer of wealth doesn't happen when markets are hitting new highs. It happens during crashes and panics, when emotional investors sell valuable assets at fire sale prices to disciplined investors who prepared in advance. The choice is yours. Which side of that transfer will you be on when the next crash inevitably arrives?